Are we witnessing a seismic shift in the commercial real estate landscape? And what does it mean for property owners and lenders? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. The United States office market is facing a significant crisis as vacancy rates climb to historic highs, according to a recent report by Moody's Analytics. The national office vacancy rate surged to an unprecedented 20.7% in the second quarter of 2025, marking a structural disruption in the multi-trillion-dollar sector. This increase is largely attributed to persistently high levels of remote work and cautious return-to-office strategies. The vacancy problem is widespread, affecting nearly every major city and suburban market across the United States. In tech-centric hubs like San Francisco, the situation is even more severe, with the office vacancy rate soaring to 27.7%, a dramatic rise from its pre-pandemic level of 8.6% in 2019. Other major business districts, including downtown New York and Charlotte, are also grappling with high vacancy rates, both nearing 23%. Even suburban office parks, once considered potential beneficiaries of decentralization, have seen vacancy rates climb to record levels. Amidst this challenging environment, a distinct flight to quality has emerged, with leasing activity concentrated in premier, modern Class A buildings as companies prioritize high-quality amenities and prime locations to entice employees back to the office. The glut of empty office space is creating a cascade of financial consequences that extend beyond building owners. Landlords find themselves caught between falling rental income and rising costs of servicing their debt, a predicament exacerbated by an estimated $290 billion in loans secured by office properties set to mature by the end of 2027. This situation is particularly acute for regional banks with significant exposure to commercial real estate debt. Moreover, the crisis is impacting municipal finances as declining property values shrink the property tax base cities rely on to fund essential public services. This creates a challenging cycle where service cuts could make cities less attractive, further dampening demand for office space. In response to this downturn, the commercial real estate industry is pivoting towards more resilient asset classes, moving away from traditional office development. This shift involves converting obsolete office buildings into residential apartments and redirecting capital towards logistics centers and modern industrial facilities. Philadelphia offers a promising case study where the removal of over 1 million square feet of aging office inventory for residential conversion has helped stabilize its center city vacancy rate at 20.4%. However, such projects face challenges, including zoning restrictions, structural mismatches, and high conversion costs, which can limit their applicability. Developers and investors are increasingly focusing on sectors with robust demand drivers, like logistics centers and modern industrial facilities, to meet the sustained growth of e-commerce and the need for resilient supply chains. While the office sector struggles, the industrial market remains relatively healthy, with a vacancy rate of 7.1%, demonstrating strong demand for modern, well-located facilities. The United States office market is not just navigating a cyclical downturn, but is in the midst of a fundamental realignment driven by post-pandemic work evolution. The speculative office tower construction era appears to be over, replaced by a search for more flexible, mixed-use, and cost-effective development models. ECI Group celebrated the groundbreaking of the Averly Richmond Hill, a $60 million, 291-unit mixed-use development in Richmond Hill, Georgia. The development features retail acreage along Ford Avenue and is positioned within the rapidly growing Savannah Metropolitan Statistical Area. ECI Construction serves as the general contractor, with construction financing provided by Synovus and the Canadian Imperial Bank of Commerce. The project is expected to deliver pad-ready retail sites in the first quarter of 2026 for prospective tenants. The Averly Richmond Hill will include 243 one, two, and three-bedroom apartment residences, along with 48 three-bedroom townhomes, each equipped with two-car garages. The mixed-use development will also feature an 8,400 square foot clubhouse, complete with a clubroom, state-of-the-art fitness center, co-working spaces, and automated package facilities. Additional amenities include a dog park, expansive pool, and 2 amenity courtyards. The development's design incorporates open-concept floor plans with modern finishes, such as vinyl plank hardwood-style flooring, quartz countertops, and stainless steel appliances. Each unit is equipped with a private porch or balcony, large kitchen islands, and ceiling fans in the bedrooms and living areas. The location offers direct access to Interstate 95 and is conveniently situated near major employers like Hyundai, Gulfstream, and Georgia ports, making it an attractive option for potential residents. Tyler Mouche, Associate Vice President at Colliers in Savannah, emphasized the development's strategic positioning, highlighting its high visibility frontage along Ford Avenue and proximity to major highways and job centers. The area is poised for continued growth, driven by advancements in the industrial and logistics sectors, which presents a promising opportunity for retailers. As ECI Group moves forward with this ambitious project, it builds on its extensive experience in the multifamily industry, leveraging a portfolio that spans over 7,500 units across the Southeast and Texas. With a strong focus on development, construction, investment, and property management, ECI Group continues to be a leader in the real estate sector. The commercial real estate market in the United States is showing signs of a shifting balance, with recovery beginning to outpace recession. This comes from the 2025 Mid-Year Commercial Real Estate Report released by Integra Realty Resources, one of North America's largest independent commercial real estate valuation and consulting firms. The report provides insights into pricing, performance, and market cycles across the office, industrial, multifamily, and retail sectors. According to Anthony M. Graziano, Chief Executive Officer of Integra Realty Resources, the U.S. commercial real estate market is actively recalibrating. The mid-year analysis indicates that more markets are in recovery than in recession for the first time in years, which is an encouraging shift. However, confidence remains uneven as broader economic uncertainty continues to influence investment decisions. Graziano emphasizes the importance of staying disciplined and focused on fundamentals to navigate this fragmented and fast-moving market. The report highlights a continued bifurcation in asset performance, with capital and tenant demand reflecting a clear flight to quality. Investors and occupiers are prioritizing high-performing assets that meet modern operational needs. As capital becomes more selective, underwriting is driven less by broad market momentum and more by long-term staying power, location, and resilience. The office market remains bifurcated, with ongoing challenges in legacy cores but signs of recovery in lifestyle and Sunbelt metropolitan areas. Nationally, vacancy remains elevated, particularly in urban cores like San Francisco and Chicago, where hybrid work and downsizing continue to affect demand. However, Sunbelt and lifestyle-oriented metropolitan areas such as Miami, Charleston, and Boise are showing signs of stabilization. Demand is focused on high-quality, well-located assets, reinforcing the ongoing flight to quality trend. In the multifamily sector, recovery is led by northern and midwestern metropolitan areas, while Sunbelt markets work through supply. Cities like Chicago, Philadelphia, and Minneapolis are seeing greater stability as new supply slows, while markets in the South and West, such as Austin and Phoenix, continue to adjust to prior construction activity. Rent growth has moderated in oversupplied areas, but remains healthy in infill, high-barrier, and affordable markets like Indianapolis, northern New Jersey, Los Angeles, and San Diego. Retail continues to outperform expectations, with strength in mixed-use, grocery-anchored, and lifestyle centers. The sector's recovery phase markets rose significantly, while recession phase markets dropped significantly, reflecting a positive shift in consumer behavior and retail strategies. The industrial sector remains healthy overall, but is entering a transition period as speculative development deliveries push vacancy higher in some major markets. Vacancy is rising in metropolitan areas like Dallas-Fort Worth, Indianapolis, and Philadelphia, where new product is outpacing absorption. Rent growth is flattening in oversupplied areas, but remains positive in land-constrained and infill markets such as San Jose and Richmond. Looking ahead, Integra Realty Resources notes that while signs of stabilization are emerging, elevated capital costs, shifting demographics, and policy uncertainty remain key challenges as we move towards the end of the year. In the western region of the United States, Pacific Coast Commercial Real Estate has completed a notable transaction in the multifamily sector. The Del Oro Apartments, located in the vibrant Hillcrest neighborhood of San Diego, California, have been successfully sold for $4.5 million. This value-add multifamily property was acquired by John Lopez and Cheryl Lopez from an undisclosed seller, with acquisition financing provided by Citizens Private Bank. The Del Oro Apartments are situated at 3748 to 3772 10th Avenue and 918 Robinson Avenue. This property includes an 18-unit apartment building and an adjacent duplex, offering a mix of 15 studio apartments averaging 326 square feet and 5 one-bedroom, one-bathroom units averaging 447 square feet. Additionally, the property features 9 garages and is zoned RM39, which provides certain development opportunities. Ken Roback and David Dilday of Pacific Coast Commercial represented the seller in this transaction, while Patty McKelvey of Coldwell Bank West represented the buyers. Escrow and title services were managed by Chicago Title Company, ensuring a smooth and efficient closing process. The sale of Del Oro Apartments highlights the ongoing demand for multifamily properties in desirable urban neighborhoods, even amidst broader market fluctuations. The Hillcrest neighborhood, known for its vibrant community and proximity to downtown San Diego, continues to attract investors seeking strong rental income potential and long-term appreciation. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.